Good morning, YouTube. Thank you guys for tuning in. Bennett, TyndallTradingAnalysis.com, hosting for our fearless leader, Mr. Todd Gordon, today. Happy Wednesday, June 23rd. I hope you guys are doing well. Taking a look at the futures market, you can see on the left-hand side of your screen, we've got a intraday S&P futures chart, 5-minute chart, as well as a watch list, just kind of giving you an overview of what we're looking at here into the open. We've seen some interesting moves in the market following the Fed meeting from last week. Last week we were looking at, in the S&P, some contracting price action that we anticipated at least delivering some sort of a three-wave corrective pullback. We've since seen that pullback and we've had a pretty good move back to the upside. We're going to look at the charts here in just a minute, but before we do so, let's go ahead and bring in the trading analysis team. Good morning, Terry, and good morning, Alex. How are you guys doing, gentlemen?
Good morning, members.
What's happening? You guys doing well today?
Viewers?
Well, here hot, over
Is it
100.
Oh, good. Is it humid? Let's see.
No, not much, but
I tell you what, in California, the Central Valley of California, we'd get up to like 105 to 110 sometimes, but we didn't really have any of the humidity that I now experience here in Texas, and it's a different environment. It's not Florida status, but it can get a little bit tropical. So yeah, it does look like it's warm. It's warm over there. You got, gosh, 104. It looks like coming up. So
goodness, I saw the Weather Channel yesterday. They were showing up in the Northwest. They're getting some really high temperatures. I think Portland, Oregon was supposed to set a record high temperature sometime this week. There's a high pressure system's way up in Canada, and it's pulling all that hot air up out of the desert up into the Northwest there. So said 90% of the homes built up there don't have air conditioners.
Oh,
so
that's painful.
Yeah.
You know, you can ask the little Amazon devices. I'm not going to say it because it's here in the office, but you can ask her the hottest place in the world and the coldest place in the world. It's kind of fun, but half the time I ask her, it's always this place called Furnace Creek, California, that it's 115 degrees. My goodness. So
must be right there in Death Valley.
Yeah. Yep.
yeah,
Yep. Certainly.
Yeah, it's nice day.
Well,
Hey.
the weather's not the only thing that's hot this week, Bennett. It is the market is on fire. So let's jump into that frying pan and see what's happening.
Sounds good, guys. I'm going to take them through the charts. Motivate platform will be back in just a minute. Good morning once again, YouTube, and thank you for tuning in. Okay, so let's jump into it. Let's not waste any time this morning. Futures are, looks like they're ticking back to the upside here. So jumping in using the Motive Wave platform, one of two tools that we utilize here on a daily basis. All right, so first of all, let's just reiterate the fact that regardless of what the wave count is from the COVID lows, we've been tracking an impulse that essentially originates from the March 5th lows. And this overall interpretation has been relatively clear. We've been fairly confident in our forecast and our wave interpretation since, I'd say, gosh, May 12th and the May 19th move. The wave count has been a little bit difficult to decipher and to count in real time with any degree of certainty. The one takeaway that we did notice was the fact that regardless of whatever the wave count is from the COVID lows, and regardless of what the heck is going on here between the May 12th and May 19th low and the June 14th high that we had prior to the Fed meeting, last Wednesday we were looking at this kind of contracting price action in the S&P, higher lows, lower highs, or higher highs, lower lows. Excuse me, I'm in triangle mode, jumping ahead to my to a video I'm getting ready to do this afternoon. But what ended up happening, and we said, look, regardless of whatever the heck the count is, this contracting price action does appear to be a little bit lethargic and in need of a corrective pullback. And we got that. If you dive in, taking you off of the 1 hour time frame, down to the 15-minute chart, you ended up with a move that is a little bit tricky to or I should say not tricky, but can be counted in a couple of different ways. The overall takeaway, however, is that we ended up with more or less a 3-wave measured move, with wave C being equal to A. So you've got a standard 535 Elliott wave zigzag. That took you into just shy of about a 50% retracement of the move from the May 19th low. And we are seeing continuation to the upside. So with that in mind, I am now beginning to view this 3-wave corrective pullback as a retracement of that leading contracting diagonal and setting us up for wave 3 continuation. In the event that this is perhaps some sort of a fake out move, maybe similar to what we had back in May when we moved up here prior to selling off to our 40.5 support zone. If that's the case, there are 2 key zones of resistance that you need to be watching, but take a look at some of the underlying flows. I don't think we do see this end up materializing as a B wave. If that were to be the case, you know, we would be looking at revisiting support back from May 12th and May 19th. So those 2 levels essentially have confluence near 42.82 up to 42.86. This would represent a 1272 external retracement of the June 14th through June 18th decline. The next 1272 is up to 42.8674. And that's just simply an external 1272 retracement of the decline from May 8th through the May 12th lows. So that's the S&P 500. Let's shift focus to the Nasdaq 100. The Nasdaq 100's wave count has actually been more clear than the S&P. And what we looked at last week was essentially this zone of fib resistance, which you'll notice here, we're kind of getting into what would be considered the extremes for a wave 5. And interestingly enough, as we kind of push into this clustering of fib resistance, that also has more or less confluence with an overhead resistance line, which essentially is just sourced from the Feb 16th high through the April 15th and April 28th highs. And that's kind of where we're seeing a little bit of hesitation in the Nasdaq. So this interpretation here would give us the possibility to see a corrective pullback here into, you know, the first or second week of next month. This is kind of plan A or plan B, I should say, in the event the markets do reject this zone. If we keep pushing through this zone and this contracting, overlapping 5-wave move in the Nasdaq 100 does not yield a corrective pullback, the interpretation that I'll be quickly adopting is the one that you see here in front of you, which let me take you to a 195-minute half-day chart. It's a little bit easier to count. So very similar to what we just viewed before in our other count in the Nasdaq, we still have from the Feb 16th high 3 waves down, 3 waves back, except we actually completed triangulation. You have C, D, and E. Wave 4 triangle completes June 3rd. This is 1, 2, taking you down to the 15-minute chart, bringing in the smaller degrees of trends. This would essentially give you from the June 14th high into the June 16th low, 5 waves up, 3 waves down, a 61% retracement, excuse me, and then we go. So that's kind of what we're looking at here at Trading Analysis. I'm very much so looking forward to this market moving. There's a lot of really healthy consolidation at work in many tech stocks, many growth, semi stocks. So I think there's significantly more upside ahead and an upside possibility. We'll continue to track it and continue to take it one wave at a time. If you're interested in staying up to date, I do put out a nightly strategy video update for our members, and I also do updates on our Trading Analysis YouTube channel. So that's it for me, guys. Let's touch in with the SMH. Looking at the SMH, we also gave you, from the May 12th low, we identified that as a 5-wave move. What's kind of interesting here is if I take you off of the daily, we'll go down to a 1 hour chart here. So from May 12th, you have a move up in 1, down in 2. Wave 3 completes June 1st, just over the 200% Wave 4 nets about 61% of the magnitude compared to wave 2, is sideways paired up to a directional wave 2 zigzag. That supports the guideline of alternation. We identified this clustering for you guys last week. All it's given us is 3 waves to the area of the previous 4th. Is that all she wrote for semis, and we're getting ready to continue higher? We got to keep our eyes on this as well. So that's it for me. Let's go ahead and jump back over to the team. Terry, Alex, what do you guys think?
I'm going to ask you, go back, Bennett, because I want you to cover the Russell and look at what's been happening.
I would love to. I would love to. Let me jump back here.
We frequently at the tertiary index. Okay.
You know, what's interesting is we looked at, I don't know if you had a chance to review my strategy video from last night. I was looking at the Russell 2000 wave count here, and I actually see a trading opportunity possibly setting up. It's interesting that we have here, so we're looking at a 195-minute chart, and Terry, I do have your mic enabled if you want to chime in. From Feb 19, or Feb 9, we're viewing this as sideways triangulation concluding on May 12th. No.
And really, this is the reason we haven't been paying a whole lot of attention to the run. It's just been sideways, like, you know, chop, chop, chop. Why would you want to try to analyze all of this noise? It's really difficult until you identify a point where we're ready to break either higher or significantly lower. That's when these indexes really get interesting. So it just to say why we typically don't spend a lot of time on the Russell is it's not been going anywhere.
Yeah, no, excellent point, Terry. I mean, look at this. Feb through, gosh, we're just now getting through the D wave highs from April 29th. Your next B wave high from the 16th up at 2359. So the way we're looking at this particular count, and let me just take you over to the daily first. You can see this sideways triangulation. We are counting a likely post-triangle breakout in development in small caps. And what we've got is taking you back off the daily to the 195-minute chart. From the May 12th lows, you have 5 waves up. Here we'll drop to a 1-hour chart. You can see the subdivisions a little bit more clearly. You have 5 waves up here, a very sharp 7 swing structure. You've got to get down to like a 5 to 15-minute chart to count those 7 swings to call it an ABC move. But it is appropriate. It took you right to the 78.6% retracement. From there, you have 5 smaller waves in 3. Wave 3 was greater than 1, so wave 5 can be whatever length it wants to. Wave 4 was just shy of about a 38% retracement, and then wave 5 completed just shy of our typical 5th wave fib targets. Actually, quite appropriate considering the wave 3 being just over the greater than 1. Now, here's where it gets interesting. Because in the small caps, we have 7 swings lower. Look at this, 1, 2, 3, 4, 5, 6, 7. That's 7 major price swings. When you have 7 swings, it's either 5 waves, B, C, or so extended A, B, C, or A, B, extended C. In this case, we're on a 1-hour chart. We can't count a discernible 5-wave move in A. So that's the A wave, that's down in A, up in B, and here's your extended C wave, where you do get the clear 5-wave subdivision. That wave 2 was about 50% in price and time, just shy of price, or excuse me, just shy of time, just over in price. Now, if the move off of the top is not 7 swings and it's going to turn into a 9-swing directional move, we would need to essentially stay out of the territory of 2305. Because if it's going to be 9 swings, this is 1, 2, this is 5 of 3, we're in 4, and we're going to get 5 to new lows. But does this chart
we don't want to see
like
4
that?
overlap.
Yep.
Yeah, don't want to see 4 overlap too. So.
Yep, absolutely. And what's interesting is a move through that could essentially act as a trigger for a long setup. Here's the alternate view, which back over on the daily, instead of us being in triangulation, this is just a series of 3-wave moves essentially. Down in A, 3 up of B, and this is where the move off the top, we would say, okay, instead of this being A, B, this is 1, 2, here's 5 of 3. Wave 4 would need to stay out of 2305.71. So if you get north of 2305.71, could be getting ready for wave 3 of 5, which could take you significantly higher in small cap. So good call checking that out. And we're going to be diving into that more with members.
Yeah, because without that analysis, you really have no conviction to go either way. And it's really easy to be lazy, do one wave count, pick it and go with it and make wrong trades.
Yep.
And we try to do additional analysis, give you the alternates. And until we can invalidate one of the multiple counts, we really have to have conviction both ways. As we start to invalidate the alternate counts, then we increase our conviction that the remaining count is more likely the correct count. And certainly when we can establish those target and trigger levels, that's when we'll be ready to increase our conviction one way or the other. So.
Yeah, very well said. And no other form of technical analysis can give you such precise levels of trade, either validation or invalidation. So love it. All right, Terry, you want to bring us up to speed with sector focus?
Okay.
All right, let's jump into it.
Hello traders, I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So what a roller coaster ride we've been on this past week. Who needs to go to a theme park to get their thrills when you can get that in the markets right here, yeah? Following the highly anticipated Fed meeting last Wednesday, the S&P moved dramatically lower, down 1.9%. on the week, especially on Friday, which was quadruple witching day. Now, oddly, the declines really seem to be heaviest in the value stock sectors, right? But interestingly, look down here at the NDX. The NDX last week actually maintained a positive gain throughout the week, netting about a 0.37% rise. Now, large cap growth stocks, it seems, did not succumb to the market bears. Okay, so we have technology up here, discretionary, and communications actually outperforming the S&P, which is right here at the negative 1.91. So outperformance in tech. Here's healthcare. That's not a tech, but it was also outperforming a little bit. But our leading sectors were rocked, really, with no pun intended. Materials and financials both down over 6% the week, followed by energy down 5.4%, industrials down 3.77%. So, like I said, though, communications, healthcare, and discretionary still negative on the week, but they declined less than the S&P. And then the XLK, you can see, still had a slight positive gain. So, but let's fast forward here to Monday and Tuesday and look at this reversal in action. Monday saw the S&P, which had dipped on Friday below its 50-day simple moving average. That's this blue line here. Rebounded sharply, and essentially Monday and Tuesday's combined price action has erased all of last week's 1.91% decline. Now for the NDX, Monday and Tuesday's 1.57% gains have added to last week's 0.37% gains and have actually pushed the NDX 100 here to new all-time highs. Let's move over to take a look here at our weekly rotation. I have these sectors here sorted by their relative strength ratio. And here is the rotation. Let me zoom out a little bit so you can get a little bit more tail action there. So let's see here. So starting with financials, we've seen financials down here in the weakening quadrant. The financials moving slightly left, but as I animate from last week to this week, and I pick up Monday and Tuesday's tail, you'll note that energy is actually has hooked and has retaken #1 lead. So now we have the energy sector outperforming the financial sector, whereas prior to that, financials was the highest relative strength stock. So there's one rotational change that's happening. Okay. Another that's happening is real estate. So the real estate sector is the one that's most new to the leading quadrant, and we helped narrate and guide you through this path as we saw the real estate sector back here in April pushing higher, eventually showing an improving trend, pushing over into the leading quadrant, and we narrated that change. So now what has happened most recently, you'll see here between materials and industrials actually showing some declining momentum. Real estate snuck in here and jumped right up in the list. And so now we have energy, financials, and real estate in order of rank by relative strength here. Materials and industrials, communications, all three of these are still leading sectors, but this we've seen this common theme that materials tends to be following industrials around the rotation, and it certainly looks like it's continuing to do that right now. Industrials has pushed down into the weakening quadrant, though the vector tail, I will say, does appear to be slowing a little bit. Okay, you can see the difference between the velocity of energy moving up with increased momentum versus this one little line segment of industrials moving down. So much more velocity coming back into energy than there is velocity leaving either materials or industrials. But nevertheless, these two indices or sectors are in somewhat of a decline. They're in a consolidation phase. Opposite of that, though, we are seeing rising momentum here in the communications sector. This sector lost 1.54% last week, but has risen 1.65% in just the past 2 days. So with this rising RRG vector, the XLC is still holding above its 20-day moving average. Let me pull that chart in here for you. I think it's easier to just switch over to here. So this is the price chart of the XLC, and I track here the 50-day moving average, the 20-day moving average. You can see the consolidation completed here around May 19th and was really not confirmed until about May 26th. It's been kind of it's been a leading trend on these daily candles. This little small correction that we saw last week, it was very muted, right? It was nothing near the nearly 2% decline the overall S&P had. You had a very slight decline in the XLC, recaptured itself here on the 20-day moving average and is moving higher. And let me sort these by price change this week. We can take a look here at Roku, Live Nation, Twitter, Facebook, and Charter Communications, but Roku up 10% this week. Let's jump back over here to our rotations and talk about technology. So interestingly, with technology holding all of its gains, I'm actually kind of curious. I'm seeing a little bit of decline of relative strength here in just Monday and Tuesday's action, but momentum is holding steady. So ideally, we want to see that technology continue to push higher up here into this improving quadrant and then recapture some legs. And then eventually we'll see technology back over here just as we did here with the real estate. But we are still playing it very cautious. Like Bennett has showed you, we've got alternate counts that tell us that we don't have a clear signal to just go all in on tech right now. But I tell you, I am seeing certain signals that are giving me that hints. And really, it was last week growth just dominated over value. I mean, it was a bigger change than I had seen before. So, yeah, the XLK did hold positive, just about a 0.08% gain last week. It saw an additional 1.8% rise in the past couple of days. Let's take a look at the price chart here of the XLK. This XLK also, it tested these resistance levels last week at its all-time highs. Interestingly, again, last week's decline, it did not reject from that line as dramatically as the other sectors did. And now with Tuesday's close, if you can see this candle right here, this last bar right here is Tuesday's close. We actually now have the XLK at all-time or at new all-time highs. And here's another positive thing. The 20-day simple moving average is crossed above the 50-day, is now moving higher above that 50-day simple moving average. And the uptrend appears to still be intact. I'm going to talk about healthcare. Let's go back and take a look at the healthcare sector. So the healthcare sector has been here in the improving quadrant, has been moving in a northeasterly heading. It does appear to be rolling over slightly, but again, this very last bars are only Monday and Tuesday, so that last little line segment is not complete until the week is complete, but it's giving us an early hint that a little bit of momentum is coming out, or maybe coming out of the healthcare as it pushed itself up. But you can still see here in staples and utilities, both of these vectors, those guys are actually continuing to decline, and even utilities is declining even more rapidly. I'll show you a price action here on the XLV. And it's clearly still running above its 20 and 50-day simple moving average, but it has kind of been choppy and sideways, and it's not penetrated above this 125 handle. So there's why momentum seems to be stalling, is because it's not yet made a new high above this here. And that recent pullback in the XLV, like the tech, was very modest, and even bounced off of the 20-day. But right now, all of this price action essentially sideways since May 10th. If we look over here, I'll sort this. Yeah, it's sorted by a percent change. We've got HCA, Danaher, Edwards Lifesciences as being the top movers this week in healthcare. Staples and utilities, there's really nothing interesting going on there. I'm going to skip those. Let's take a look here at discretionary. We hadn't talked about that. So let's go back over here. Although the consumer discretionary sector is still seen here with the lagging vector on the weekly RRG, I think similar to healthcare, the declines in this sector this past week were very muted. The XLY lost 0.61%, but the XLY seems to be the velocity here is not increasing. I don't like the fact that it is still moving into the southwesterly heading, but let's take a look at the price action here. So basically, since the first of this year, we've seen two major corrective moves in the XLY. Very possibly, recently, we have broken out of this consolidation, and we are setting ourselves up here for some type of new uptrend. So despite the fact that we are down in that weakening quadrant, this may be the perfect entry point. This could be newfound support right in here for a new uptrend in play. Tuesday's price action did break above a previous resistance level, which I've now turned to green here. It did come back just slightly, so I will say that's still kind of 50-50 whether we see that. If we see the XLY continue pushing higher there, I'm going to start looking inside this sector for some big opportunities. Let me share with you the RRG. I don't typically do this, but it's a big mess right now in the discretionary. There's a lot of the leaders are actually seeing some big declines. I just don't see the common theme of everybody moving in the same direction. So I'm still playing my cards very carefully here, but there are a few indications of some rising momentum that we want to look at. And one interesting thing here, the largest market cap stock in the XLY is Amazon. And Amazon has now given us a blue improving trend, and over the last several weeks the vector has been pushing eastward, which means increasing relative strength. It's holding a steady momentum, And that is a good clue that we could see ultimately the XLY all pushed back together. But like I said, collectively, the whole sector itself is not moving in unison. That will come eventually, but there's just some early signals there. So I'm going to leave it there for now and hand it back to you, Bennett.
Thank you, Terry. Appreciate it. Yeah, interesting moves there in the RRGs. That hook kind of roll over there in tech, I think maybe could be an early indication that we do get that little bit of a corrective pullback. But my goodness, with everything else we're seeing in the markets, it's going to be a great trading opportunity if it comes. All right, Alex, sir.
Yep.
Can you hear me now? I'm going to pass you the presenter mode.
Let's
see. Make presenter, come in your direction. All right, guys, Alex is going to take you through a bit of a macro overview. And, of course, all right, should be good to go. And, of course, he does have a crypto-specific show tomorrow morning, 9 a.m. Eastern on our Trading Analysis YouTube channel. All right, let's do it. Here we go, Alex.
Hey guys, so let's go in a little bit of macro space where we have seen some of the things happening lately. So last week Fed was relatively hawkish with the transitory inflation narrative.
Alex, I don't know why it just dropped your screen share.
It dropped my screen share?
Yeah.
Okay, can you pass me again?
It says you have it.
Yeah, it shows you as presenter currently.
Technical
well, yeah.
Here, I'll do this. I'll pass myself presenter, and then I'll send it back to you, which should prompt you to share your screen. Sometimes those
yeah.
There we
Do
go.
you see it now?
There we go.
All right, here we go.
Okay, so let's start with the dollar index outlook. Fed was pretty relatively hawkish, and dot plot, which Powell specifically said it's individual opinion by the member of the committee, was relatively bullish on rates in 2023. So dollar index made something which looks like a potential five-wave move up. If we look all of the move from the March 2020, I will look this as one of the things which are relatively rare in the Elliott wave world. I will put here a fifth wave truncation, which means that from a little we basically failed to put a new low. This subdivides well as an ending diagonal, so I would still look like this, like wave 4, down in 5 with a small truncation, and I need a 5-wave move here to basically hammer the ABC pullback in dollar. I don't think this dollar move will be something which will take either more time or a more higher in price, taking all of the things in consideration regarding the transitory inflation narrative. So I would look for either simple or complex pullback in the ABC. I have a wave count where this might be still a wave 1 and 2 and further dollar move lower, but I don't think this will materialize simply because I don't think there is a macro environment in these possible rate moves on the upside for the dollar to continue on the downside. So this will be my primary wave count. As long as we are tracing this impulsive move on the upside, especially if we finalize this with a 5-wave move in a potential wave A towards these resistance levels, a little bit below 94, I will be looking for a move down in B and move up in C. As the rates are concerned, I will just show you my 10-year Bund. So this is the Bund price. I've been vocal very much about this chart And I think it's telling the story of transitory inflation, especially in Europe. And for now, this macro scenario is working out. I think as long as we hold this support, this chart represents a very transitory inflation for a year or two, potentially in this triangle consolidation. But this support zone will be my key zone to look for. And from there, I will be looking for higher deflationary forces with demographics and technology to kick again into deflationary scenario, which will be beneficial for gold and for a Bitcoin, since and as well as stocks. So we can potentially see with the counts that the guys has on the stock market, we might have experienced a correction very soon in stock market, but I think it's going to be of a temporary nature. I don't see for now any gloom and doom predictions. So on that front, I just see it as a kind of a transitory correction before we go again into this deflationary environment and expansion of the central bank's balance sheet again for this move up in this wave 5 on the German 10-year Bund. If you are asking for the US might experience a little bit more inflationary outlook. These 10-year yields are holding well. These support levels, this looks for now corrective. And I'm going to be looking pretty soon potential move up and test of this 2% on US 10-year yield. For now, this wave count still shows potentially bullish interpretation, because from this move up and a correction, we can structure some type of a possible 5-way move on the upside. We will see that yet, but this small consolidation has held pretty nicely around 1.5. 1.4, and I think potentially we might start to see, even if not currently immediate, barely soon, I think we're gonna start exhibit a potential move for this 2% floor that we have here. Where is the next resistance levels? So on front, which everybody is interested about regarding Bitcoin and gold, Bitcoin still stays, according to our wave count, I think we are in the crypto winter. I have been very vocal about this for the last couple of weeks, much before then this drop was starting to unfold. I was looking a little bit higher levels, around 74K, but we came to 64K, and I'm looking for a corrective pullback still in this wave 4. We have a 5-way move now lower, which indicates that we are going to have an ABC pullback. So I think with the current development on these lows, we might get ABC pullback on the upside, 50% 0.618 retracement there might be something which we are going to look for, especially if we see a 5 waves up from this current crypto lows. Crypto community was pretty much unfortunate because people bought the dips, thinking that from some of these levels, this recovery might be very quick. But when our members ask me that, I always say, look, we lost almost 700 billion in market cap very quickly, and in the current macro outlook and the potential slower liquidity pump by the Fed, I don't think that will be possible, at least for some time. And that kind of also kind of a new normal regarding COVID. People want to travel, take a little bit rest of their desks, spend some money earned. So in general, I think we're going to drag out in this correction for more next couple of weeks, or even a month or 2 or 3, until this unfolds. My key level is around 20K, 17K, where I will look for a potential support and potential further developments on the upside in the crypto. So as long as we trade below 13,000, since we are followers or practitioners of the Elliott wave methodology, we have to look this as a 1-2, up in 3, down in 4, and up in 5 for now. Our wave counts are unfolding pretty nicely for now. We were looking for some complex or a simple correction, either a triangle, and on the end, ABC probably is going to win for the pattern for this corrective pullback. I will just show you gold. There has been many things regarding gold in the last couple of weeks. We have been very vocal about the gold chart with our clients regarding this potential X wave. Actually, we were looking for a clear 5 waves up on this pattern to show us a potential move up, but we were very cautious on a potential X wave, which actually unfolded, and after the Fed, gold dropped down, and this will give this correction a further time to move. We are going to see probably either an intermediate triangle here in another X wave, or if you count this as an ABC for W, X wave triangle, move lower, it really doesn't matter. But on the more directional count, if we see a 5-wave move down to this 1,600 levels, we might see just an ABC down to this 1,500, which will be a next support on a higher time frame. You can subdivide this differently. This can be 1 and a big wave 2, or you can do an expanding leading diagonal in a lesser degree, 1, 2, 3, 4, and 5. It from the trading perspective, and in this moment, it really doesn't matter. Are you put the orange wave 2 or a blue wave 2 here? Even if this is the orange wave 4, it's gonna potentially finish around these levels which I mentioned, with the one more move on the upside, which is a pretty big target above 2K. Again, once this correction is unfolding and finish, and I think it's pretty goes well with the dollar index currently. So silver, and then I'm going to go back to you, Bennett. We didn't also buy this silver pullback or a move on the upside, I would say. I will construct this for now also in some complex corrective pullback down to 2021 levels to pair this with gold and the current potential bull outlook on US dollar. So whatever the structure of this, you can do several wave counts on this one. Either this was the W in flat, some X wave, we have another ABC down for Y. Whatever wave structure you put here, or a triangle, we are going to finish around between 23 and 21, potentially, especially when we see a 5-wave move lower. So I'm gonna go for a silver with a little bit more downside, and in gold, and it will take some time for this to unfold. I will be looking for end of 2021, beginning of 2022 for both of these, and then potentially a little bit more deflationary environment if the economy balances itself. This will have time to rise. Yeah,
Alex, are you seeing similar things happening in other commodities, such as wheat and soybeans and copper? Are we seeing the commodity trade come off for a short while?
Yeah, I will show you my charts on soybean, so on wheat as well as on copper. So soybean has a very kind of a helpful pattern from the lows. So this is a weekly chart. I'm going to go daily just to see for you something that you might see actually the subdivisions. Soybean is from these lows in a leading diagonal in 1, down in 2, very nice wave 3 on the upside. So we are waiting here for kind of a resolution, either a 5 waves up, 5 waves down in A, up in B, down in C, or if we stay in 3 waves, potentially a triangle. Again, I think as well as in gold, we will see a 5-wave move lower, as we are going to see 5 waves up in dollar higher, then a B wave pullback, and then a final C wave before we go further on the upside in soybean. Also, if you look wheat, wheat has been in a very complex pattern. I will show you my weekly wave count, which was working pretty nicely, even though it is a complex one. I'm going to look for an X wave, so a potentially finished consolidation in triangle in a B wave, move down with the dollar up in a C wave for the X wave, and then we might see a furthermore move on the upside in wheat as in soybean. So I consider this just to be a small pause, as I see on gold and silver. And finally on copper, we are trading on copper in a corrective mode from the 5-way move on the upside. So if you look this sequence, you can clearly see a subdivisions here. This might turn into a little bit more complex, especially if we don't see a 5-way move. For now, we are only seeing a 3-way move. So one form or the other, this basically is suggesting for now that we might see a corrective pullback again to November, September, November in 2021, and then a potential move higher in copper as well. Support is very well around 3.4. This is the futures chart where the 38.2 retracements rest, and the second one is at 50% around 3.144 for copper. So I'm waiting a little bit just to put the final kind of a wave pattern here to see how it's going to develop further. But as you can see on the commodity front, while the dollar is moving up, except oil, everything is pushing down, and that's in line with the inverse correlation of the commodities and gold. So back to you, Bennett.
Thank you, Alex. Much appreciated. Hey, we do apologize. A little bit of his chart was cut off. We got that resolved there towards the end. Anything, guys?
I think those lumber prices came down too, didn't they, Alex? People were getting a little bit anxious there. Home builders' cost of materials was really getting high, and lumber came off also. So collectively, all of that commodity pricing moving down means the dollar strengthening against those commodity trades, and that's what Alex was showing you. That's why he likes to show that DXY chart, right? That one has probably the most influence over all of the markets. The reason we follow this macro, we don't actually have a commodity trade service here, okay? But we follow this stuff to see the global implications of what the macro environment is happening, because that's going to ultimately drive how our equity companies' performance is going to go. So that's thank you for that, Alex.
Yeah, no problem.
Yeah, absolutely. Very well done.
Market is open now, Bennett. And I see energy up 1.43%. Semiconductors are up 0.5%. Discretionary is up 0.5%. So it's the gates are open. What else do you see going on there? Otherwise, we're going to leave it there for you guys. And what else you got, Bennett?
No, that's about it. Good show. We've got our member webinar starting in about 20 minutes. We have tomorrow morning Alex's show. You can go to tradinganalysis.com to find the link, or you can go to youtube.com/tradinganalysis. We'd encourage you to check us out. If you did enjoy the content, please give it a thumbs up, subscribe with notifications to stay up to date. And yeah, good show. That move in lumber, it was interesting. I was looking at the chart. The high was like a perfect measured move of C versus A, or maybe it's 3 versus 1. We're going to find out. So anyways, excellent job. Great job, gentlemen. Appreciate it. Markets are open, and we'll see you guys all next week. Sound good?
Yeah.
All right, guys. Have a good one, and we'll see you then. Take care.
Hi. If you don't know me, I'm Todd Gordon. I worked in the trading markets as a profession and a passion immediately following college 19 years ago. As I've grown older, my trading and investment style has changed. As I've grown as a trader, my holding period for my investments was also growing longer. I was learning firsthand that being properly allocated in the right stocks and sectors on a longer term time frame with proper hedges in place and the idea of compounded returns are the keys to building real long-term wealth for most of the investing community. You can short-term and swing trade the stock and options market if you like, but do so with a very small percent of your capital. And by no means should you be trading with a majority of your investable assets or your portfolio. For our clients in Trading Analysis, we recommend that you don't trade with any more than 20% of your portfolio in the strategies for our members at tradinganalysis.com. The rest should be managed by a professional financial planner. So last year I ventured out to make a final evolution of my career in the markets. I left the very capable team at Trading Analysis that I built to run the day-to-day operations. I set out to build a wealth management business leveraging our reputation from CNBC and our years in the financial markets. We'll be launching soon, so please keep an eye out for details. If you'd like to be updated as information becomes available, please visit www.tradinganalysis.com/investments. Again, thanks very much for your interest. Look forward to what the future holds. Cheers, and let's get back to the